today we're talking about key terms when buying a home. Now, buying a home, it seems simple because we've all lived in a home or an apartment of some type all of our lives. But when you're looking to buy a home, sometimes common terms take on a different definition. So stay with me for the full time length of this video if you're looking to buy a home right now or in the near future. So again, I'm going to be going over some key terms that you need to know when buying a home. Now, it's not that these terms are difficult, you just probably never heard them explained in this particular way, okay? So, the first thing we'll talk about, let me just get up here. All right, here we go. So, the first term we're going to be talking about is appraisals, okay? Let me blow this up a little bit, okay? What it says is that an appraisal is a report highlighting the estimated value of the property completed by a qualified third party. All right. It says lenders rely on a to validate the home's value and ensure they're not lending more than the house is worth. Okay. So first we have appraisals. Appraisals are done by an appraiser. So they're going to come in, they're going to spend about 5 minutes in your home. And what they're going to do is they're going to compare your home to other homes in the area that have recently sold. This usually happens at the end of the process. Why is that? That's because the bank is not going to pay more than what the home is actually worth. So, for example, if your home, if you agree to buy a home for $200,000 and the appraisal comes in at $200,000, okay, no harm, no foul. Okay, nothing happens. But if the appraisal comes in less than what the home, you guys agreed to home, now you're in a situation. All right, what's that situation? Let's say you bought a home, you agreed to pay $300,000 for home, but now the home comes and it's appraised at 250. Okay, or let's say 260. It appraised for 260. That's a $40,000 gap. So one of three things can happen. Either the seller could bring down the price. So they you agreed to pay 300 for it, but now the bank is saying, hey, based on this appraisal, we're going to only give you 250,000 260,000. So the seller can bring his price down to 260. All right. Or what could happen is that buyer could fill that gap with cash. So they could bring $40,000 more. Or what could happen is they could meet somewhere in the middle. So, for example, in this example, the seller could bring the price down to 280. The buyer could bring that $20,000 extra. Okay. The appraisal is paid for by the buyer. It usually runs $600-700. Now you can use a credit card to pay for the appraisal, but it is a soft cost. So it's not in the closing cost, but it is a closing cost. All right. So let's go to the next one. Let me 1 second here. Okay. So the next one we're going to talk about is the closing cost. All right. So the closing cost is the fees required to complete the real estate transaction paid at closing. Ask your lender for a complete list of closing cost items, including points, taxes, title insurance, and extras. And this is correct. Closing costs, when people ask me about closing costs, now again, this is going to come from the lender. But as a realtor, I usually tell people if they're looking for some type of measurement or benchmark, I usually tell people it's going to be around 10%. Now, that's not for everybody. All right. But if you're looking for a rule of thumb, my rule of thumb for most buyers is, hey, how much are you going to pay in closing costs? Going to be around 10%. So if you're looking at a home that's $200,000, then I say, okay, your closing cost is going to be around $20,000. Now, it's not going to be 10%. Okay. Because that's a little high. It's probably going to be around 8 or 9%. But I tell people 10% because number one, it's easy to remember. And then number two, if you do have 10% saved for your closing costs, including down payments, then you're going to be straight. All right. But you do want to know at the onset what the projected closing costs are going to be so you can make sure that you have enough money. All right. So like it said on the screen, closing costs they include points, any origination fees that the lender is charging you, also title insurance, also transfer taxes. Okay, in Philadelphia, which is a bit hefty. So you got transfer taxes from the city, you got transfer taxes from the state. You also, like I said, title insurance. So you do have a bunch of things that you need to know, be aware of. But in general, okay, in general, if you want to know what your closing costs are going to be, it's going to be around 10% of what the purchase price is. Okay. All right, let's go and let's talk about the next term. All right, the next term here is score. Okay. A number ranging from 300 to 850 that's based on an analysis of your credit history. This helps lenders determine the likelihood you'll repay future debts. Okay, so cost. Oh no, I'm sorry, not close cost. Credit scores. What does your credit score have to be? I usually tell people if they want for an FHA loan to get only to be able to only put 3.5% down, your credit score needs to be a 620 or better. Now you can get a loan at 500 to 620 as far as FHA. But the thing about it is that you're going to pay a 10% down payment, okay, at that 500 credit score. So really, nobody really does that, okay? I'm sure somebody in the stratosphere has done it. I've never seen anybody do it because people ain't really trying to put 10% down. But if your credit score is from 500 to 620 or 619, yes, you can still get a loan, but your down payment is going to be 10%. Okay. Now, when you hit 620 and over, now you get into 3% as far as your down payment. And then that coincides with what I said on the previous as far as your closing costs. Your closing costs, if you and here's a point of clarity. When some people say closing costs, some people separate closing costs and down payment. Okay. Closing costs are costs of the loan. Your down payment is the required monies that you have to put down towards that loan. Okay. When I'm saying 10% for the closing costs, I'm including the down payment. Okay. But back to credit score. Your credit score needs to be a 620 or better. Okay. If you have a 620 or better, then we can start doing this. And the higher your score is, the more programs you'll have available to you. But here's the thing, okay? Don't get so caught up in your credit score that you, oh well, I want to wait till 6 months or higher score, and then interest rates. So you're waiting, for example, say that you have a 620. You're like, oh, I want to get a 700. People have told me that. I've had people who they were at a 620 or maybe a 630 or 640. Like, oh, well, I want to wait a couple months for my credit score to go up. The credit score went up, but at the same time, interest rates went up. So it canceled each other out. So now you're at the same payment. No, don't do that. Okay. I definitely wouldn't do that. What I would do is I would see what I'm qualified to get right now, see if there's a house out there suitable. Can the payments fit my budget? And then I would take it from there. Okay. All right. So that's credit score again, 620 or better. Higher, the better. Let's go back to our screen. Next, we have down payment. We talked about this a little bit. Okay. Payment. Down payments are typically 3.5% to 20% of the purchase price of the home. Some 0% down payments programs are available. Ask your lender for more information about what you qualify for. Okay, let's talk about. I'm going to change this a little bit. Okay, we're not going to talk about down payment. Let's talk about down payment assistance. But let's talk about down payment a little bit. Okay, yes, down payment goes from 3.5% to 20%. People don't usually pay for a house that they're going to live in. They usually don't pay 20% unless they want to. Okay, people are usually looking because money has been so cheap recently. Not really now, but in the past has been so cheap. It really made more sense to borrow the money versus using your own money. Okay. So, but the least 5%, some conventional programs do have 3% loans out there. It just depends. It depends. It depends on the bank. I really wanted to get at is not all people think that, okay, um, this one bank or this one mortgage has access to all the programs. That's just not the case. It's just not the case. Okay. Different lenders have access to different programs. Different banks have access to different grants and down payment assistance programs. Okay. So Bank of America has a totally different program than Chase. Chase has a totally different program than Wells Fargo. Wells Fargo has a totally different program than Key Bank. They all have different programs. So that's why getting pigeonholed with one lender may not be the best thing. And the reason is why is because, yeah, you can get pre bank ABC 123, but bank 456 may have a program that's giving money. Okay, so we really need to shop around, and I do have a program for that. I have a bunch of super duper qualified lenders, but they all do something different. They all have businesses that they want and businesses that they don't want. For example, in general, banks are a lot more stringent than lenders. Okay, but banks, and I'm not doing a broad brush, but banks loans a lot of times are cheaper than mortgage lenders, but mortgage lenders are more flexible. Okay, so you definitely need a realtor to kind of navigate those waters of lenders. So let's keep it going. Okay. Oh, this okay. Now we have mortgage. It says the mortgage rate to borrow money when buying a home. As mortgage rates fluctuate, consult a lender to know how it can impact your monthly mortgage payment. So we have interest rates. All right, blow this up a little bit. We got interest rates. Interest rates is the rate that you have on your loan. So right now for 30-year fix is around 6.5. But here's the thing. You can always refinance. All right. I had a guy at a open house this past Sunday yesterday. And he asked me like, so you think mortgage rates are going to go down? And I'm kind of looking at him like, my guy, where we're at right now is the average. Historically speaking, right now we're at average rates. Are we at historical lows like we've been in 2022 and 2021? No. But now I think the market, we got to settle into this new normal. Okay. I personally believe interest rates are not going down. Now, there we really in 2023 we have to look at inflation because if inflation continues to increase, the Fed is going to continue to increase rates, okay? Which will in turn increase the price of borrowing money. But I don't see interest rates going back to 3% or 2.5% or even the high threes. In this year, it may get down to 5. Okay. It may get down to 5, but this is the new normal. So we really have to start adjusting. Okay. We have to adjust to these mortgage rates that we have right now. Okay. But again, understand that you marry the home and you date the rate. And I've heard people like bash this statement, but it makes perfect sense to me. I bought a home in 2017 and the rate I bought it for like 6% or something like that, but I refinanced it. And when the rates went down, right now I got a 15-year mortgage at 2.6%. Okay. When everybody was refinancing, I refinanced that puppy also. Okay. But if I would have waited, that house I bought for like $90,000 right now is probably worth like 180. Okay. So if I'm listening to people at that time and I'm like, oh, well, interest rates, you cannot take or you cannot participate in the equity run up if you don't buy something. Okay. All right. I'm off my horse on that one. Next, we have approval letters. All right. A letter from a lender that shows what they're willing to lend you for your loan. This plus an outstanding of this plus an outstanding of your savings can help you decide on your target price range. This plus an outstanding, I don't know, I think this is wrong right here. It says this plus an outstanding of your, maybe the plus a statement of your savings. I think this is wrong. Anyway, all right. Anyway, a pre-approval. Okay. Um, a pre-approval is a letter from a bank stating what, based on the information that you gave them, what they're willing to pay you or lend to you. Okay. Now, there's two things. You have a pre-qualification letter and you have a pre-approval letter. What are the differences? The pre-qualification means that you're just calling a lender and telling them, hey, I make this, I have this in the bank, my credit score is this, so on and so forth. Nothing's verified. Okay. That's a pre qualification. A pre approval letter, most of the time, should be where everything is verified. If you're looking to buy a home, you need a pre approval to see where you are. Now, a lot of people, they stop because they say, oh, well, I want to get my credit ran. All right. It's necessary. You have to get your credit ran. Okay. So, and here's the thing, getting your credit run is only 10%. New inquiries on the makeup of the credit score is only 10% of your full score. So that means it may knock you down a point or two, but at least you'll know, hey, I'm qualified for $200,000 or I'm qualified for $300,000. Now, what I do for my clients is I know that within a certain amount of time, you can get your credit pulled. You can get your credit pulled 30 or 40 times within 14 days. It all counts as one pull. Okay. So I have a bunch of lenders lined up and I have you fill an application with all of them. And we see who comes back with the best rate, who comes back with the most down payment assistance. And we can kind of go shopping there, if that makes sense. All right. So let's go to the next one. All right. This next one is inspection contingent. Okay. So what it says is a provision in a contract requiring an inspection to be completed. This essential step gives you information on a home's condition and potential repairs. Okay. So next we have I'm sorry, inspection contingency. I think I said home inspection because that's what I thought it was. All right. You know how sometimes you kind of memorize stuff so you're not actually reading it. But this is an inspection contingency. So what an inspection contingency is that when you go to get a home, most of the time you want to get an inspection. What's an inspection? An inspection is an inspection report paid for by the buyer, where you hire an inspector to inspect the property for the any exposed issues. The inspector is not going to go through the wall, okay? The inspector is not going to go through the wall. But the inspector, he's trained, he's certified. So he's going to look for all the issues and he's going to give you a report stating that, hey, these are the issues. So you're aware. So when you're going to see homes, it's not that you have to be the inspector yourself. Okay. When you're going to see a home, there's three things you're really looking for. Number one is the neighborhood because you can't change that. Number two is the size. You can change the size, but not so much. And number three is the finishes. You can change all of the finishes. All of the finishes you can change. Even if you tear the house down and bring it back up, you can change it. All right. So with this inspection, you'll have in most contracts, if you put it in there, is that you'll have a due diligence time, just say for average maybe 10 days. In that time, what you'll do is you will hire an inspector in Philadelphia. The home inspection, a radon inspection, and termite inspection, all that usually costs 5, 6, 700 bucks in that neighborhood. Okay. So that person, that inspector is going to schedule a time for you to be there also, and y'all going to go through the property. Y'all going to walk through the property. Now, when you walk through the property, you'll still have time to back out of the contract. You'll still have time. So don't worry. Okay. Don't worry. You don't have to be the inspector on every house that you go into. Okay. But you have a contingency, meaning that you can still get your money back and you can walk away within that due diligence period for any reason. Okay. All right. Let's go to this one. Affordability. All right. So what it says is a measure of whether someone earns enough to qualify for a loan on a typical home based on the most recent price, income, and mortgage rate data. All right. When home prices and mortgage rates are higher, it can impact affordability. So that's what affordability means when you're talking in the housing market. Okay. Based on the price of the home, your income, and the mortgage rates, there's something called debt to equity. Okay. Debt to equity is based on your income. And when they pull your credit, there's going to be a monthly amount on that credit. Okay. How much of your income is going to debt? Most averages is around like the mid 40s. Okay, you do have some places that have like 50s as far as DTI, which is debt to income ratio. Okay, but can you afford the property? So when they talk about affordability, that's what they're talking about. Can you afford the property? Let's go to the next one. The next one is, and this is the last one. All right. The value of your home above the total amount of liens against your home. Many homeowners are realizing they have more equity than they thought, and they're using it to move out. All right. So we're talking about equity here. Equity, for example, let me check this chat. Got any chat people here? Okay. So what this means here is equity is how much money over your liens or your mortgage is a house worth. So for example, if the house is worth $100,000, no, $200,000, and you have a mortgage of $100,000 on it, okay, but it's worth $200,000, then that means that you have $100,000 in equity. So that's one of the reasons why, that's one of the differences between this market and 2000 market, is that a lot of people have equity in their homes. So if they do, I'm looking over here because that's one of my cameras over there too. If you do want to sell your home, then you don't have to foreclose it, or there's not a lot of short sales out there because people have equity in their home. But this is something that renters can't be a part of. Renters can't take part in this. Why? Because they don't own the property. So since they don't own the property, when the equity goes up, then they can't take part in it. Okay? That's one of the benefits of being an owner. Okay? And that's why a lot of people feel that homes are investments. Okay? I turned my printer on. Homes are in investments. And the reason is because when the equity goes up, okay. I hope you guys can. When the equity goes up, you're able to participate in the equity. If you're renting a home, then you can't participate in that run up. Okay. So it's about 25 minutes here. So we ran down. It's over here. We ran down key. There we go. The key terms that you should know when buying a home. Okay. I'm Colin Nathan Alim, the real estate boy. If you're looking to buy a home, sell a home, or invest in real estate, I got you. If any of these terms you need to be more clear on, definitely contact me and I'll be happy to help you. All right, guys, take care.